Okay, we're going to continue once again for your tutorials 4 regarding your cash flow statements. So we're going to look at the SPACAT here. So SPACAT, this is a consolidated statements of profit or loss. So and then we're going to item, since the statements, the cash flow statement that we're going to prepare here will be based on the indirect method. So the things that you need to focus here is on the profit before tax, but in this case for SPACAT here you have a loss here, loss before tax. So this is the item that we need to focus. And then you have you also need to consider about the non-cash item. So for this one you have non-cash item. If you look at here, you have a gain on revaluation. So this one is related with a non-cash item, so you need to make an adjustment here. Okay, so since it's already plus, so we need to minus this amount. Okay, and then the other one is a finance cost. So finance cost we need to exclude from the loss for the before taxation, because this is not the operating activities. So we need to exclude this one. So it means that you need to add back this amount. Yeah? Okay, so you have here, so the company has a loss here, and then from that loss 654 attributes to parents loss, but for the NCI here we have a profit. Yeah. Okay, that one is related with the statements of comprehensive. So we refer back to this slide here. So slide that we have here is related with the items that you need to focus here is on the cash and cash equivalents. So the cash that you have here is 0 for the ending balance, and then beginning balance here you have 230. So if you look at for this company, you have both cash and also bank overdraft here, overdraft bank or bank overdraft. So the cash that you have here, so beginning balance of cash that you have here, the beginning balance here is 230, the ending balance here is 0. And then for bank overdraft here, for bank overdraft you have ending balance here is 160, okay, 160, and then the beginning balance here is the ending balance is 160, but the beginning balance that we have here is 0. Okay, the beginning balance is 0, the ending balance that we have here is 160. So 0 here, this one is 160. Yeah? So if you total up these two figures, we're going to have here, so beginning balance for the cash here we have 230, okay, 230, but the ending balance here, ending balance you have bank overdraft, which is negative 160. So means that at the beginning we have a positive, at the end of the year we have a negative, so means that you have an decrease by 390. So this 390 will be net decrease in cash. So this is what you need to find here when you prepare a consolidated statement of cash flow. Okay, and then we're going to, this is what we have for the equity and the liability. So we're going to look at the next one is on the additional information. Okay, for additional information here, it said that SPACAT bought 80% equity holding in Semangat. So it bought 80%. So bought here means that you acquired. So once you acquired here, you're going to have, okay, since the effect here will be assets and liability will be increased. At the same time, you're going to have a goodwill here because you acquired here. Okay, for 200 million by the issuance of 48 million equity shares with a value of RM2.50. So we have two components here of ordinary shares or shares capitals here is 48 million times with RM2.50. Yeah? So we're going to have here is 120. And then the other one in terms of cash we have 80. Yeah? So altogether this COI here will be 200. Yeah? Okay, this is the net asset of the Semangat. So the net asset of Semangat, when you total up all of this amount, you find that the net identifiable assets that we have here, NIA here is equals to 180. So that is the amount of the NIA. Then we look at the NCI here. It said that the NCI was measured based on the fair value for value 47. So we want to find here plus the NCI here 47 means that total COI together with the NCI here going to have 247. Yeah. and then we need to minus 180 to form the net identifiable asset. Then you're going to have 67. So this 67 is a goodwill. Yeah. So once you have a goodwill here, you need to find whether there is an impairment for that goodwill. And then the impairments was, if there is an impairment here, it's been recognized under administrative expense. So we look at here, the goodwill that we have at the beginning balance, the goodwill here is 67. Now refer back to your balance sheet here. If you refer back to your balance sheet, the goodwill here, ending balance here is only 60. Beginning balance 0 plus 67 from the acquisition, so you're going to have 67 here, and then the ending balance here is 60. So once the ending balance is 60, means that there is a reducing amount from 67 to 60. So the reducing by 7 here is considered as a impairment loss. So impairment loss is a part of your administrative expense. So impairment loss, there is no cash involved, so you need to add back this 7,000. Okay, that is what you have for the acquisitions here. And then they said that there is no disposal of non-current asset during the year. No intangible assets was acquired. Okay, no intangible asset were acquired apart from those acquired from the acquisition of Semangat. So intangible asset that we have in Semangat here is 30. So we try to look at the intangible asset. So intangible asset that we have in your balance sheet here, beginning balance you have 350 plus the one that you acquired from Semangat, another 30. So means that you have 380. Compare with the ending balance. So the ending balance that we have here, okay, ending balance here is 350. So 380, now it become 350. So there is a reducing by 30. So reducing by 30 here means that there is an amortizations of the intangible asset. Okay, and then said that the depreciations of plants, property, plants and equipment amounted to 07, also going to be charged to the administrative expense. So this one also we need to add back this amount. This one also need to add back. Okay, amortization of going to charge under administrative expense. Okay, all 6% bond, all related transaction or transaction related to the 6% bond were cash basis. So we need to look at your 6% bond. So for 6% bond, beginning balance we have 550. Now the ending balance becomes 680. So means that there is an increase by 130. So increase in liability means that you're going to add to your cash. Okay, and then shares dividend were paid during the year by both Sepakat and Semangat. So this one we're going to calculate for dividend for the NCI and also dividend paid by the parents. Okay, so the things that you need to prepare here, if you need to prepare the consolidated statements of cash flow using indirect methods. So this is what I will prepare. Okay, prepare. So we look at the profit before tax. So in this case you have a negative because instead of a profit here you have a loss. Loss before tax. So negative 569. Okay, finance cost we need to add back here because there is not relate with the operating activities. So we need to add back 49. Gain on revaluation, previously you minus, so previously you add, so now we need to minus because this is non-cash item. Non-cash item. Depreciation expense here, this depreciation expense is from item number, if you look at here, is item number 2. Item number 2, there is a depreciation expense of 207. Impairments of goodwill we already calculate previously. The balance, beginning balance of goodwill is 767. Now the ending balance here is only 60. So reducing by 7. So reducing by 7 here is considered as a impairment. So impairments here we need to add back. Okay, amortizations of intangibles we already calculate. Beginning balance you have 350 plus 30 from the acquisition from Semangat, so minus the ending balance 350, so you have 30. And then we look at the changes in working capital. So for changes in working capital, we're going to focus on item that you have in the current assets and current liability. Okay, the first one you have in inventories here. So for inventory, your beginning balance here is 275. Okay, and then add with the acquisitions that we have here, 25 from the acquisition from Semangat, and then you're going to have here is 300. 300 here is the beginning balance. Now the ending balance here is 400. Compared with the 400 here, means that there is an increase by 100. So increase in inventory here, we need to minus here, because this is your current asset. Remember that current asset is there is an increase, we need to minus. Decrease, we have to plus here. And then for inventory, for a liability, current liability increase, you're going to plus. Reduce means that you make a payments here, then you need to minus here. Okay, and then another items that you have in current asset here is a trade receivables. Okay, trade receivables that we have here, beginning balance 340. There is no trade receivables in the new company that you acquired, so the trade receivables here, you only compare between beginning balance and ending balance. Okay, beginning balance that we have for trade receivables here is 340, and then the ending balance here was 460. So there is an increase by 120. Yeah, increase by 120 means that you need to minus. Yeah. Okay, the next item that we have here is a trades and others payables. Okay, for trades and others payable, so you have beginning balance here, put it here, trade and others payable. Okay, beginning balance that we have for trades here is 280. Okay, 280, and then plus the one that you acquired from Semangat here, trades payable, you have 15. So you're going to have here is 200. Okay, this one will be 295. 295. Compare with the ending balance. So the ending balance that we have here is 466. So means that there is an increase by, okay, increase by amount that you have here. How much you have here? 466 increased by 171. Yeah. So increase here means that you need to plus, because this is your current liability. So we're going to plus 171. So total up all the things that you have in the operating. You're going to have to cash generated from operation, negative 345, and then you need to minus a finance cost, because previously we add, so you need to minus here because it's related with the operations, but it's not related with the to generate a profit before tax, but this profit is related with the item that are under operating expense. Okay, finance cost, we need to minus this one again, and then we're going to calculate for the income tax paid. Okay, for income tax paid, the one that you have here, so you need to look at tax payables that we have here. Okay, tax payable that we have here is 90 here, 90, and then we're going to add 80 here. Okay, 80. The 80 here is a current year tax, and then you're going to have 170. So 170. Now the amount ending balance of tax payable here is only 80. So there is a reducing by 90. So this is the ending balance. So reducing means that you make a payment. So you need to minus 90 here. Okay, so altogether you have net cash flow from operating activity with 484. Okay, and then the next one you have investing activities. Okay, for investing activity, we're going to look at item that relate with your non-current assets. Okay, for non-current assets here, you're going to have PPE. Okay, intangible asset already done. Okay, goodwill is already done. We have impairment and amortization for both of the asset. And then another things that we have here is a financial assets. Okay, and then for the investing here, you have a purchase of subsidiary. item number 1, the one that you purchase here is how much cash that you paid. So cash paid here is 80. So cash paid minus cash available in Semangat. So altogether the amount that you're going to have here is aggregate cash. So the amount that you have here is negative 60, because 80 here is the one that you paid minus 20. So since this is a purchase, so that one will be cash outflow. So that's why we put a negative sign here. Okay, now look at your PPE here. So for the PPE here, beginning balance of your PPE, if you look at the PPE is 2.7, 240 to 400. So you have 400 for the beginning balance, and then you need to minus 207 here is for depreciations, and then we need to plus the amount that you have in the PPE in Semangat. So plus 120, the one that you have in Semangat. So you total up this amount, so you're going to have 2313. Okay, this one is 2313. So 2313 compare with the ending balance that you have here is 2360. So 2360 means that there is an increase by 47. Once there is an increase by 47 means that you purchase new PPE. So purchase here means that you're going to minus here, because that will relate with the cash outflow. So you have cash outflow. Okay, and then the other items that you have here is a financial asset. Okay, for financial asset, if you look at here, we have a beginning balance here is 180. So beginning balance 180 plus gain on the disposal, gain on revaluations here is 20. So you're going to have here is 200 here. So 200 here. The ending balance here, compare with the ending balance. So ending balance here is 210. So means there is an increase by 10. So increase by 10 here means that you purchase. So purchase here will involve the cash outflow. So we're going to have negative 10 here. So altogether you're going to have 117. So this one is for operating, and then this one is for the investing. Once you have a negative sign here, means that this one will be your cash outflow. Okay, done with the investing. Okay, now we move to the next one. Okay, the next one you have financing. So for financing here is relate with your long-term liability together with the equity. Okay, so going to have here, so for the first one item that you have for the long-term liability and equity here, you have a shares capital. Okay, for shares capitals here, your beginning balance that you have here is 1650. Okay, 1650 for shares capital, and then you're going to add another, the ones that you have here is another 120. That 120 here is come from your new acquisitions here. Okay, you're going to have 120. Okay, so you're going to add the item, and then you're going to have altogether is 1790. Okay, 1790 compare with the ending balance here. Ending balance is 1770. Supposed to be 1770. So we're going to have compare with the 1900 here. So means that there is an increase here, increase by 130. So increase here means that you have a proceed here, cash inflow. Okay, the next one you have the issues of bonds. So issue of bonds here, so the things that we know here is only the difference between beginning balance that you have, and then this is the ending balance. So when this is an increase means that you receive some cash here, so you need to add 130. Okay, the next one we need to look at for the NCI. Okay, for NCI here, NCI value at the beginning you have a 0. Okay, 0 value, and then plus with the profit. So profit allocate to the NCI that we have here is 5 here, 5, and then we're going to profit, and then you also have another one that you have for NCI is 47. This one is from the acquisition of Semangat, yeah. So altogether you have 52, and then compare with the ending balance. So ending balance that you have here is only 50. So reducing by 2 here means that this is a amount of a dividend paid to NCI, yeah. Okay, so you have -2 here. Okay, and then the next one is dividend paid by parents. So for dividend paid by parents here, you need to look at the RE here. So the RE that we have here, so beginning balance for the RE is 1025. This one is for your RE, yeah. 1205, and then plus a profit here. So in this case you don't have a profit, yeah, you have a loss, so we need to minus, yeah. Instead of plus here we need to minus because we have a loss here. 654 minus 654, and then you're going to have the amount here will be 551, yeah. 551 is your beginning balance. Compare with the ending balance. Ending balance here is 504, so means that there is a reducing by 47, yeah. So the reducing by 47 here is a dividend paid by parents, so you need to minus that amount. So total out here you have net cash inflow, cash inflow you have 211, yeah. 211, this is item number 3, so you need to add item number 1, which is from operating, plus investing, and then plus financing, yeah. So altogether you have a -390, which is equals to the net decrease in cash, the one that we calculate previously. So -390, and then cash equivalents at the beginning of the period here is 230. So you're going to have cash at the end of the equivalents at the end of the period, which is 160, yeah. The amount, which is this amount, should be the same amount as reported in your statements of financial positions, and beginning balance here is in the year 2017, ending balance here is in the year 2018, yeah. Okay, so we're done with that questions 1, yeah. Okay, so we'll move to the next one, yeah. The next questions that we have here is questions 2, yeah. Okay, questions 2 is related with Purnama. So Purnama, prepare same thing that you need to prepare. So the thing that you need to focus for Purnama here is the ones that you have here is a profit before tax, 87,600. This is the amount that you have here, 87,600. And then the taxations and net profit RE brought forward, and then the other things that you need to be careful here is about this one, foreign exchange loss. This is not a part of operation, so you need to add this amount back, because you already minus, so we need to add back this one. Okay, gain on the sales of the licensed product, suppose that plus here, so suppose that you minus, but there is information about this one. Later on we're going to look at that things. Interest expense here also need to exclude here, and then we not exclude from profit before tax, but it's still under operation, but we need to exclude from profit after before tax. Okay, so this is what you have for the asset. Okay, now look at the assets that we have here is cash and cash equivalents. So if you look at here, the amount of your ending balance here is 8,200. Okay, 8,200 is the ending balance. Beginning balance here is 3,200, so means that there is an increase, so you're going to find net increase here, net increase in cash, which is equals to 5,000 here. Okay, make sure that when you calculate, the amount of net increase in cash should be 5,000 here. Okay. So that is all the items that we have. Okay, now we're going to look at the additional information. Okay, for additional information here, your cash purchase of PPE, plants and equipment totals 25 million. So this one is already given, 25 million. So this is amount of purchase. Depreciation expense for the year is 9 million. So we need to add back this one. It said that some of property, plants and equipment was sold at their book value. Okay, this is another thing. Purnama acquired a fully owned subsidiary, means that there is no NCI in this case for the cash considerations of 11,800. Yeah? Okay, and then the fair value of the company net asset at the acquisition as follows. So when you total up here, the amount of the net asset that we have here is equals to 11,800. So the all of this amount is equal to 11,800. So if you compare here, the amount that you paid your COI here is also 11,800. So means that there is no goodwill. Okay, but you need to find the aggregate cash. Aggregate cash, the one that you pay 11,800. Okay, minus cash that is available in that company, the new subsidiary that you acquired here is 800. So the amount of cash, aggregate cash here, it will be 11 millions. 11 millions will be the purchase of the subsidiaries. Okay, so same thing when you acquired here, assets and liability will increase. Goodwills we already calculate, but there is no goodwills here. Okay, this is item that you have. And then another thing that you have to be careful here is about the effect of the exchange rate. So the effect of the exchange rate will affect the cash and cash equivalent during the year. Okay, and then we have a loss of 800. So this amount of loss need to minus from cash and cash equivalents. Okay, and then the gains on the sales of licensed product was a cash proceed of 2,600. 2,600 is the same amount that you have in your income statement. So this one, since it said that in a cash proceed, means that there is no adjustment for this one because it's already paid and the amount of gain here is already in cash. So there is no adjustment. It means that you don't have to minus this figure from the profit. Okay, so you need to prepare the statements of cash flow using indirect methods. Same thing. Okay, so this is what you have for Purnama here. We start with the profit before tax, 87,600. Okay, adjustments here is for a depreciation. So depreciations here you have 9 here is come from additional informations number 1. Additional informations number 1. So interest expense here we need to add back. Okay, you have here is 8,000. So you just add back this amount, 8,000. Foreign exchange loss also we need to add back because it's not an operating activities, not from operations, not relate with the profit from operations, so we need to add back. Shares of profit in associate we need to minus because previously you go the amount here you add, so you need to minus because it's not relate with the operations. Okay, and then we have operating profit before working capitals, and then we look at here the working capitals. Here we look at the current assets and current liability. Okay, so for current assets that we have here is inventory and trade receivables. Okay, for your inventories here, so the amount of inventory beginning balance we have 39. So for inventory, okay, this one, okay, beginning balance we have 39. Okay, from that 39, since you acquired here, you add another 2. Okay, add another 2, so you're going to have 41. Okay, compare with the ending balance here. The ending balance here is only 20, so means that there is a reducing, reducing by 21. So reduce here, reducing by 21 here means that this is your current asset, so you need to add, so add 21. Okay, then we look at your receivables here. Okay, for our receivables here, beginning balance that you have for our receivables is 34. Okay, beginning balance 34, and then plus the one that you acquired here is also 2, so you're going to have 36. So 36 compare with 38, so there is an increase by 2. So increase by 2 here we need to minus here. Okay, so minus this figure. Okay, only 2 items for the current asset, and then for current liability we have trades payable interest payables, and then the other ones you have tax payables. Okay, so the one that you need to focus here is only a trade payable, because interest payable is related with the interest expense, tax payable is related with the tax expense. Okay, so for the payables that we have here, trades payable, beginning balance 37.8, and then plus 2 is here is from the acquisitions. Okay, trades payable you have 2 from the acquisition, so this one equals to 39.2. 39.2 compare with the ending balance. So ending balance that we have here is 5. 39.8. 39.8 compare with the beginning balance that you have here is 5, so means that you have a reducing by 34,800. 34,800. So since this is a reducing, and then this is your current liability, so we need to minus. So reducing in a current liability, need to minus. So you have minus 34,800. So total up here, you have cash generated from operation here is 79,600. Then we look at the interest paid. So the interest paid that you have here, the interest paid, the amount that you have in the beginning balance here is 2, plus the interest paid for a current year is 8. So altogether you have a 10. Now the amount, the ending balance of interest payables here is only 4.6 or 4,600. So there is a reducing by 5,400. So reducing means that you make a payment. So payments here you need to minus. Okay, so minus this one, minus. Okay, the next one is income tax expense. Okay, for income tax expense here, you look at your tax payables here. So tax payable, so be careful with the income tax here. You need to look at the items. So put it here, the items here is a income tax payable together with the deferred tax. Okay, if you look at here, the beginning balance that you have for tax payables here is income tax payables here is 20, deferred tax is 0, so you're going to have beginning balance of 20, and then the ending balance. Okay, ending balance that we have here 8 for tax payable, and then 15 for a deferred tax, so altogether you have 23. Okay, so this is your beginning balance, and then this is your ending balance. So beginning balance here, if you look at here, you have the tax that you paid for a current year. You paid tax for a current year, the amount of taxation here is 23. So 23, so you need to add with the current tax. So current tax here is 23, so you're going to have 43. Altogether is 43. Can I put it here? Okay, move to here. So beginning balance of your tax here is 20. Okay, and then current tax here is 23. So altogether you're going to have 43. So 43, this is your beginning, and then compare with the ending balance. So ending balance that you have here is 20. So means that there is a reducing by the ending balance here is 23. 23. And then means that your reducing here will be 20. So reducing by 20 here means that you make a payment. So you have 20 here. So total ups altogether here you have net cash inflow. Net cash inflow is 54,200 from the operating. Okay, the next items here is related with your investing activities. Okay, for the investing activity, focus on your long-term assets. Okay, long-term asset, the first thing that you have here is the investment associate, PPE, and also PPE. So the first one that you have here is acquisitions of subsidiary. So acquisition of subsidiary here is item number 2. We only need to find an aggregate cash. So this is your aggregate cash. Okay, the other items that you have here is your PPE. PPE. So for the PPE that we have here, investment in associates here. Okay, if you look at your investment in associate, so if you look at here, there is no effect. So if you look at your investment in associate, beginning balance you have 40, and then plus with a profit 10, so 50. Ending balance also 50, so means that there is no effect, no effect, so there is no cash involved for investment in associates. Okay, the next item that we have here is a purchase PPE. So we look at the PPE here. Okay, for purchase of PPE is already given, so this one is item number 1. So the next one, you need to find the changes of the PPE here. So the changes on the PPE here, beginning balance you have 17. Okay, this is your beginning balance, and then you need to minus depreciations. Minus depreciations that you have here is 9. Minus depreciation is 9 for the PPE, and then we need to add 13. 13 here is the one that come from the new acquisition, from Semangat, so 19. So altogether you're going to have another one here plus 25. 25 here is from the one that you purchase. So altogether that you're going to have for your PPEs here will be 24,600. Okay, so you're going to have here 17 plus 13 plus 25 minus 9. So altogether you're going to have for this one is equals to 24. So 25 altogether. You have 25. So next 25. Let me calculate that one. Okay, 17 plus 13. So 30 here plus 25, the one that you have here, 55 minus 9, minus 9, so you have 46. Altogether you have 46. Okay, and then the ending balance that you have. Okay, so you're going to have here altogether is 46 here. Okay, compare with the ending balance. So the ending balance that we have here is 45,600, 45.6. So means that there is a reducing by 0.4. So means that you sell some of the PPE. So that's why you have a proceed here, positive here. So total up these three, so you're going to have negative 35,600. Negative here means that net cash use or net cash outflow, either one use or outflow. Okay. Okay. And then we're going to move to the next one. Look at the financing activities. Okay, for financing activities here, we have the proceed from the issuance of shares capitals here. How to find this figure is only, there is nothing relate with the shares capital, so just compare between the beginning balance and the ending balance. Compare, there is an increase by 5 here. So increase here means that there is a proceed. Okay, and then for long-term debt, if you look at your long-term debt, okay, long-term debt you have here is 2800. Okay, 2800 is your beginning balance, and then look at what you have in the one that you acquired, another 4,000 here. So you're going to have 24,800 here. Okay, that 24,800 is the one that you have here for that long-term loans. 24,800. So you need to compare with 31. So the amount has been increased to 31. Okay, so the difference that you have here is 6,200. 6,200 here is an increase. So increase here means that there is a proceed from long-term debt. 6,200. Okay, done with this one. And then we look at the dividend paid for the NCI. Since you acquired fully owned means that there is no NCI. So we only need to calculate dividend paid by parents. Okay, so for dividend paid by parents here, we need to look at the returns earning. Okay, so for returns earning, the one that you have here, beginning balance here is 27,600. Okay, plus profit for the year. Okay, profit for the years, so in this case we only have a parents here, 64,600. Okay, and then we need to minus. Okay, we need to minus the amount that you paid for a dividends. Minus 24 for a dividends. Okay, and then you're going to compare this one. So 27,600 Okay, 27,600 plus 64,600. Okay, and then minus. Okay, so you're going to have 92. Okay, 64,600 plus 27.6, so you're going to have 92.2 minus 24. So you're going to have here is equals to 98.2. So 98.2 compare with the ending balance. So the ending balance that we have for the RE here, the amount of the ending balance here is 68,200. Yeah? Okay, the ending balance 68,200. Okay, so what do you have here? Total up this amount. Okay, so actually dividend paid is already given, so you don't have to calculate this one. Already given. So again about this one, this is already given. So you're going to calculate. If you want to calculate here, we need to minus this one. So because at the end we're going to have the amount is equal to ending balance. Yeah, it's equal to ending balance. So to calculate this one, we just total up the beginning balance. So to save it, 27,600 plus 64,600 from the profit. So you're going to have here is 92. Okay, 92,200. Yeah, 92,200, and then minus the ending balance that you have here is 68,200. So the difference here is 24. So the 24 is a dividend paid. If you don't want to calculate this one, actually the amount is already given in the income statement. So it said that interim profit paid by cash here is 24. You don't have to calculate that one, but for the purpose of preparing the statements of cash flow, you still need to show this one, because every single items that shows here will give you a marks for this one. Yeah, so we need to calculate. For this type, we don't have to minus this 24. If you minus the 24, at the end the balance is equal to the ending balance. Yeah? Okay, actually the dividend is already given. Yeah? Just no need to minus this amount. If you minus this amount, it will equals to your ending balance. Is your minus 24 here, then it's equal to 68,200, which is equal to your ending balance. So to find a dividend paid, you just use the beginning balance plus the profit and then minus the ending balance. So you have 24 here. So you're going to have here net cash use in the financing. Use here because we have a negative amount here, 12,800. So and then we need to, if the effect of exchange rates here, it said that the effect of exchange rate relate with the cash effect to the cash and cash equivalence here. So the effect here, we have a loss. So we have a loss here. So since we have a loss here, we need to minus from cash here. Okay, so we minus 800 here. Okay, so altogether the financing, investing and operating, we add together here, we're going to have net increase in cash, which is 5,000, plus the beginning balance 3,200, and then we're going to have the ending balance here is 8,200. Okay, so that is what we have for Purnama. Okay, so now we're going to proceed with question 3. Okay, for question 3 here is relate with Uttara. So Uttara here, this is a financial statement that you have for Uttara. So the things that you need to focus here is about this one. Okay, but finance cost. Okay, maybe we need to use another colors here. Okay, the one that you need to focus here is on a finance cost. We need to add back this one. Gain on disposals here of subsidiary, we have to minus. Same thing of this one. Yeah, both of this one we need to minus. So the thing that you need to focus here is on the profit before tax income. Okay, and then we're going to look at the next one. This is the statements here, very small. So but you have the question, the item with you. So we look at the cash and cash equivalents here. So in this case, we don't have any bank overdraft here, so we only focus on this one. Yeah, okay, so your beginning balance that you have here is negative 110, 100. Now that this is a beginning balance, the ending balance here is positive 3,000 here. So to get this positive 3,000, you need to have an increase by 4,100. So this one will guide you, means that when you calculate here, you need to find that when you total up operating plus financing plus investing here, the amount should equals to 4,100 here from your statements of cash flow. Okay, so this is what you have. Now we're going to proceed with the additional information. Okay, for additional information here, on 1st of April, Uttara disposed. So now we dispose. So once you dispose here, assets and liability will reduce, and then you're going to have a gain on disposals. So gain on disposal is already given, which is 800 in your statements of income statements of profit or loss. It's already given. Okay, so you dispose here for cash consideration 3.4. So 3.4. Okay, 3.4, and then you need to look at how much the amount that you have in that company, cash that you have in the company. So cash available that you have here is 500, so your aggregate cash here is equals to 2,900. From the disposal you receive 2,900. Okay, the company measure the non-controlling interest based on the proportionate shares of the acquiree identifiable asset. So you need to find the acquired. Since you are using a proportionate shares, means that this goodwill is not to the NCI. Okay, it's not for the NCI because you measure NCI based on the proportionate shares. So you need to find your net identifiable asset. So if you total up all your net identifiable assets here, when you total up, the amount here is 3,200 here, 3,200. But from that 3,200, you need to minus 200 here because the goodwill here is not for NCI. So the total net identifiable asset for NCI, for NCI here will be 3,000. So NCI portions here will be 20%. 20%. So you need to time with this figure. So you're going to have here for the NCI here will be 600. Okay, NCI value here is 600. 600 here we increase the NCI amount. Okay, so you look at here, the next things that you have here. On 10th of April, you acquired 30% interest. So acquired 30% interest here, paid 2 million. This one is related with the associates here. Okay, a new company here still become the associate though. So this one is under investing activities. The carry amount of PPE amounted of 1.5 million was sold at 1.8 million. So if you look at here, the cash that you receive here, cash received here is 1.8. So this one is under your investing. And then you need to find the gain here. The gain here, cash that you receive 1.8. And then the cost here is 1, or the carrying amount here is 1.5. So you're going to have gain on disposals here is equal to 0.3. Okay. Okay, cost of sales include depreciation expense of 1.2. So this is what you have here. Okay, so need to prepare the consolidated statements of cash flow. Okay, we just prepare for that one. Yeah, this is what you have for questions 3. Yeah. Okay, so net profit before tax 7.7. Okay, adjustments that you have here is goodwill impairments. So goodwill impairments that you have here, okay, we have to get this one, 600 plus 200 minus 100. Okay, look at your goodwill here. If you look at your balance sheet, the amount of goodwill that you have in the balance sheet here is beginning balance here is 1,000. So 1,000 is the beginning balance. You need to minus 200 here. So 200 is the one that you dispose. So you're going to have a balance of 800. But now the ending balance here is 600. So this is your ending balance. Means that there is a reducing by 200. So reduced by 200. So that 200 is become your goodwill impairment. So we need to add back 200 because this goodwill here is non-cash item. Yeah. Okay, depreciation is given. So given in item number If you refer back, it's already given in item number 4. Okay, shares of profit in the associates here, we need to minus here because we add here because it's not an operating. Okay, gain on disposal of subsidiary also need to minus because it's not related with the operations. Okay, and then we have gain on disposal of the PPE also need to minus here because it's not related with the operations. Okay, finance cost. Okay, finance cost, sometimes it use an interest expense, is the same. Interest or finance is the same, so we need to add back that 500 here because it's not related with the operating, not generate, it's not for the operating activity, not related with the profit before tax. Okay, and then we have in operating profit before working capital changes. Okay, the first items here is your item that you have in the current asset. So you have inventories here. So beginning, this one is your beginning balance 280. You need to minus 2,800 here, and then you need to minus inventory that we dispose 500. Okay, minus here, dispose 500, so balance that you have here is 2,300 here, 2,300, and then compare with the ending balance. Okay, ending balance of 3,550. So there is an increase here, increase by 1,250. So increase by 1,250, we need to minus here because this is an increase here. Okay, then we look at the next item that we have here is trade receivables. So, okay, trade receivable beginning balance 2,200. Okay, 2,200 minus the one that you dispose for trade receivables here is 280. Okay, 280, we dispose that amount. Okay, and then we're going to find that this one you're going to have 1920. Okay, 1920 is your beginning balance. Compare with the ending balance 1750. Means that there is a reducing by 170. So reducing by 170, we need to plus. So we plus this figure. Okay, and then for trades payable, so that is done with the current asset. Okay, for current liability, we have a trade payable. Deferred tax we're going to use for income tax later. Okay, for trades payable, you have 1,300. Okay, 1,300 for a beginning balance. And then minus the one that you dispose here is 500. Yeah, 500. So you're going to have here 500. So you're going to have 800. What should you have here? Again, trades payable. Trades payable, sorry, not 500. For trades payables here is 500, isn't it? 500. No, that one is trade bank. Trades payables here is 180. Okay, where is my pens here? Okay, we have 180 here. Okay, so 180. You need to minus 180 for the trades payable. So you're going to have for this one will be 1120. 1120. So 1120 compare with 600. So 600 means that there is a reducing by 520. Yeah? So reducing, this is your trades payable. Reducing, this is your current liability. So you need to minus. So reduce means that we make a payment. So you total up cash that you generate from operation here is 6,200, and then add back with the interest paid. So interest paid, there is no information about interest payable, so you just use the item for interest paid here, 500. And then you look at the tax here. Okay, if you look at the tax here, tax that we have here is before this we used to calculate for tax payment, yeah? But in this case, if you look at here, the tax that you have here, okay, if you look at the tax that you have here, you have deferred tax. Deferred tax. Okay, deferred tax balance. Okay, so the deferred tax balance, beginning balance, if you look at here, deferred tax, the beginning balance that we have here is 210. Okay, 210, and then plus with the tax that you paid, plus the amount of tax that we pay is 2,000 altogether. So you're going to, and then the amount that you have in the tax payable in the one that you dispose here is 500, so minus 500 from the disposal. So altogether here we're going to have 3600. Okay, 3600, and then you compare with the ending balance. So the ending balance here we have 11400 here, so means that there is an increase by 7800. So once you have increase in the ending balance of tax, so means that this is a refund, refund. Okay, increase in tax, increase in ending balance means that refund. Okay, if there is a reduce in the ending balance, then we're going to have payments. Okay, 7800 plus this one is a refund, so we need to plus that amount. So we're going to have 13500 from cash operating activity, 13500. Okay, done. And then we move to the investing. So for investing activities here, look at your PPE. The first items that you have here is your PPE. Okay, PPE here 32 is your beginning balance for 32. Okay, we're going to have beginning balance 32. Okay, 32 we're going to minus the one that you dispose here. This one is related with your PPE. 32 we're going to minus 2.6. Okay, minus 2.6, the one we dispose, and then minus 1.2 for a depreciations. Okay, minus 1.5 here is the one that you dispose. Okay, so the one that we dispose here, so you're going to have here altogether, you're going to have here is 26.7. yeah, so altogether going to have 26.7. okay, compare with the ending balance. So ending balance you have here is 20,000. So means that there is a reduced by 6,700. So reduce 6,700 means that this is a proceeds reduced in the ending balance. Reduce in the ending balance, so you're going to have a proceed of 6.7. yeah. Okay, and then proceeds on the disposal of PPE. Another proceeds that we have here is the one that you receive from the source of the PPE, item number 3. yeah. Item number 3 is already given at 1.8. okay, and then the other ones you have a dispose of subsidiary here. So dispose of subsidiary here is your aggregate cash. When you calculate this one as your aggregate cash, which is 2.9. okay, and then acquisitions of associates here. Okay, acquisitions of associates here is from item number 3. Item number 3. Proceed from this. Okay, sorry, this one is item number 2. Item number 2. Proceed from you bought a new associate, acquire a new associate, so this one we're going to minus. Okay, and then other items that we have here is features and fitting. Features in fittings, there is no information, we just compare between the ending and beginning balance. So your beginning balance here is 1000, the ending balance become 3.5. okay, this one is the ending, so means that there is an increase by 2.5. so increase by 2.5 here means that you purchase. Increase mean purchase. Okay, so another items that relate with the investing here is relate with the dividend received from associate, because you acquire associates here. So from the associates here, we're going to find if there is any dividend received here. So dividend received from associate is under investing, but if dividend to the NCI, dividend by parents here is under financing, because associate is a part of your investment. So we're going to look at your associates here. Maybe we need some space here. Okay, can I put it here for the associates here? Okay, for the associate we're going to calculate here. If you look at here for the associates here, beginning balance 22,500. okay, beginning balance, and then plus the one that you acquired. Okay, acquired here is 2 million, and then also plus shares of profit. So shares of profit that we have here from your income statements, you have 700. Shares of profit here will be 700. So altogether you're going to have 25,200. Okay, 25,200 is the balance that you have here. And then compare with the ending balance. So you have here is 25,200. Compare with the ending balance. So the ending balance that we have for the investment in associates here was 15,610. 15,610. So reducing here means that you paid for a dividend. So the amount, the difference that you have here is 9590. Reducing means that this is a dividend paid. Okay, dividend paid. So this is what you have here. Dividend paid by associate here means that you receive from the associate. So you're going to add that amount. So total up here you're going to have 16,490. That one is for the investing activities. Okay. Next one we proceed to the financing activities. Okay, now we look at the financing activity. Okay, for financing activities here is related with the shares capital. Shares capital's beginning balance here is 52. The ending balance here is become 27,010. So means that there is a reducing here, reducing by 24,990. So reducing by 24,990 here is a share buyback. You buy back your own shares. So that one we're going to minus a reducing minus means that you involve some cash, you buy back your own share means that you need to pay to the existing shareholders. Okay, and then we're going to have a dividend paid to parents. So dividend paid to parent, we're going to look at the RE. So RE, you have 2.7 for the RE. That one is the beginning balance. Okay, and then plus profit for the years, profit to the parents 4.7. So altogether you're going to have 7,400. 7,400. And then compare with the ending balance here. So ending balance you have 6,400. So there is a reducing by 1,000 here. 1,000 here is considered as a dividend paid. Okay. Then we look at the NCI. So the next one you have NCI here. So for NCI here, okay, NCI we look at the beginning balance 1,800. Okay, and then going to have, okay, the one that you have here is shares of profit 1,000. Okay, 1,000 shares of profit. Okay, and then we need to minus 600 here. 600 here because of the disposals. Disposal of 600. So we need to minus that one. Okay, so altogether for the NCI here we're going to have, okay, 2,200 here. 2,200. And then compare with the ending balance. Ending balance you have 2,300 here. 2,300. Beginning balance 2,200. Ending balance 2,300. So means that it is higher by increased by 100. So increased by 100 here means that you have a proceed from decreased stake in the subsidiaries. If that one is a decrease, let's say ending balance is lower than, this one is for NCI, NCI, ending balance is lower than beginning balance, then we're going to have a dividend paid. Okay, ending balance is higher than beginning balance means that there is a decrease in stake, decrease in NCI, so this one will be proceed to parents. So this is what we have. Okay, 100. Okay, total up. So cash generated from financing activity we have negative 25,890 plus the total up that financing investing altogether you have to have for 100 plus beginning here, and then you're going to have the ending amount of cash. So this items is refer back to your statements of financial positions. Make sure that your calculations here should be net increase here is equals to the difference between beginning balance and the ending balance of cash. Okay, so done. Okay, so we have done with the tutorials for so okay, please make sure that you understand this one. Okay, so now we're going to proceed with your tutorials 3 question, which is not yet discussed here, is questions 2 and questions 3. Okay, so we look at question 2 first. Okay, for questions 2 here, P acquired 75%. So we're going to have here, okay, P acquired 70% interest in S. P in S, we're going to have 75%. In S, considerations paid here is 70 million on 1st of January 2017. On that date, the return profit was 11.4. So return profit 11.4 in S. So 11.4 is the RE at the dates. Okay, and then the shares capital here is 60. If you look at here, so you're going to have here NIA. So NIA for S here is equals to 60 for shares capital and then plus 11.4 for the RE, so 71.4 at the acquisition state. P subsequently on 1st of January 2018 acquired 30% in A. So again, P have in A 30%, 30% on 2018. Okay, and for cash considerations of 31 million. The return profit of A at that date was 8 million, and then P treated this investment as investment in associate and then account using the cost method. On 1st of July 2019, P disposed 20% of its holding in S for cash considerations of 15,300. Okay, 20% of its holdings here means that 20% divided by 75%, which is equals to 15%. So not divide, supposed to be times. Okay, so we're going to have here 20% out of that 75 here, 20% times 0.75 here, which is equal to, not divide, times, it's supposed to time with, because it said that dispose 20% from its holding. So this 20% time with 75%, so which is equal to 15%. You dispose 15%. So before this you have 75 and then you dispose 15%, so you're going to have a new shares here, is your holdings here become 60%. So since you still have a controls here, this one is only a movement in the equity. Okay, so this is one that you have for the income for the trees company, P, S and A. A is associates here, A is associate. Okay, and then for S is a subsidiary with a 75%, A is only 30%. So this one is before additional information. So later on we're going to look at the additional information that we have there. Okay, so this is a profit. Okay, this is profit for A, and then this is a profit for S. Okay, so we're going to proceed the next one. We're going to look at the additional information. So we're going to analyze this one. Okay, and then it said that maybe this color is not clear, so we might have a red in color. Okay, so you said that S acquired 25% interest in A on 1st of March 2020. So S acquired 25%. So S is a P has a control over S of 60% after it disposed that 15%. Only have 60%. Okay, and then S acquired 25% interest in A. Okay, 27% interest in A. So indirectly, P also have a shares through S here. So P have a shares through S. How much that you have here? You need to time with 60% here, time with 25%. So indirectly, P going to have another 15%. So 15% plus the direct previously is 30%. Altogether it have 45%, still as an associate. Okay, but P also can have a control over A through S. Okay, and then S acquired at the price of 32, and then this transaction is not yet recorded by P. Okay, S sold merchandise to P, so S sold to P here, so this one is a upstream sales. Okay, with a profit margin of 20% on sale. In the year 2020, sales was 9 million, and then 3.2 here is remain as the inventory. So this 3.2 here you need to time with 20%, 25%, sorry, 25%. Okay, so the amount that you have for the URP carry forward here, you're going to have 800. Is equals to 800. Okay, and then it said that the intercompany sales and ending inventory in the prior year was 3 million and 800 in ending inventory. So this is your RP brought forward. So your RP brought forward here is 800 times with 25%. So you're going to have here is equals to 200. Okay, so 200 is the URP brought forward. Okay, this one is between S and P. Okay, and then A sold lands to S. So A and S on 31st May 2020 for 5,000. So 5 million. The book value was 4 million. So this one is a 1 million. You have 1 million gain profit. Okay, unrealized profit. Okay, this is the value of shares capital. S is 150 at the acquisitions date, and then on 1st of March the value of A is 150. So we need to look at this one because there is a transactions happen in A on 1st of March. All dividend were not paid during the current year. Dividend income was included as others income. Any gain or loss disposal is on shares are accounted in other income. Company tax rate is 24%, but tax effect on unrealized profit should be ignored. So it means that you need to account for a tax. There is no changes in the shares capital. All revenue and expense are assumed to be occur eventually throughout the year. So the group policy is to measure NCI at fair value. So NCI going to be measured at fair value. So you need to prepare consolidated journal entry and consolidated statements of profit or loss. Okay, and 30 June 2020. Okay, so this is what you have for the from associate it become indirect subsidiaries here. So from associates here is A. Before this P only have 30%. Okay, and then after S acquired A, okay, 25%. P in S they have 60%. So indirectly P control A through S. So this one is the intermediate parents here. Okay, so this one is from associate to indirect subsidiary. So this is a little bit different from your notes here. From your notes here is from subsidiary become associate. Okay, so we look at here at the acquisitions date, parent has 75% in S. Okay, means that NCI has another 25%. Okay, and then you dispose this one on 1st of July 2019. The financial year end was on 30th of June 2020. So this one is the on 1st of July 2019. So still include in the year 2020 financial statement. Okay, so indirectly as now as after the disposal on 1st of July 2019, so you sold 50%. Now the holding in S here is only 60%. This one is after 1st of July 2019. P only control 60% in S. Okay, after 2019, 1st of July. Okay, so for the in A, P has 30%, which is considered as associate. Indirect from S here is 15%, so altogether P have 45% in A. Okay, and then for the NCI here, direct in S is 25%. In A will be 45% here. 45%, where do you get this 45% here? So 45% direct here, because in A S has 25%, P has a 30%, so altogether for 55%, so another 45% is to S, so to NCI, so you're going to have 45% to NCI. And then indirectly here 40% times with 25%, so 40% here is, since in S, okay, as P has 60%, means that NCI has 40%, yeah? So 40% as in A here is 25%, yeah? So you're going to time with these two figures, so you're going to have here is 10%, 40 times with 25%, yeah? So you have another 10%, so altogether NCI going to have 55%, yeah? So this is what you have for the effective interest, yeah? Okay, to calculate for the effective interest, indirect interest, direct and indirect interest. Okay, now we're going to calculate the value of the company between P and S to determine the journal entry. Okay, for P and S here, the first thing here you need to find the company fair value. Okay, the company fair value here will be based on the NCI value, because it said that based on NCI value, because NCI here is measured using fair value. So we're going to start with the NCI, yeah? So parents have 45%, NCI has 25%, yeah? Okay, so net identifiable asset is 71,400, yeah? So we start with this NCI, yeah, to find the value of the company. So the value of the companies here, if you look at here, the value of the company here at the acquisition date, okay, at the acquisition date, which is on 1st of January 2017, the share price of S here is RM1.50. So RM1.50, to find the value here, you time with the number of shares. Okay, the number of shares that we have here is 60, yeah? So 60 times with RM1.50 here, we're going to have 90. So the 90 here will be the value of the company as a whole. So time with 25% here to find the value for the NCI, yeah? So time with 25%, so you're going to have here is 22,500. So the 22,500 is the value of the NCI, yeah? Okay, the value of NCI 22,500. Parent price here is the one that parent paid to acquire S here is 70. So altogether the company value here will be 92,500, yeah? NCI, we start with the NCI first, yeah? Okay, and then total with the parents COI 70, so you have 92,500. Then we calculate for the goodwill, compare with these two figures. So the goodwill that you have here is 71. No, this one is net identifiable asset, so the goodwill here will be 21,100, yeah? Okay, from that 21,100 here, okay, parent portion here is 70%, 75%, and then you just total up here, 75% time with 71,400, so you're going to have 53. Time with 75, this one is time with 25, so allocations for goodwill to parent will be 16,450, and then for the NCI here will be 4,650, okay? So the next one we need to calculate for the disposals here to find the movement in the equity, because when you dispose 15% here, you still have another 60%, so any changes in the value here of the NCI here is only the movement in the equity, because you still have a control over that company, yeah? So we want to calculate for the positive movement here. We're going to look at the shares that we dispose here. Okay, the sales proceed that you have here is for 15,300, the one that you receive. Okay, and then the COI here is 70 million based on the original COI. Time with the one that you dispose here is 15% over 75%, so the value here will be 14 million. Compare with this one, you're going to have gain on disposal for a parent side here will be 1.3, yeah? Okay, we need to make an adjustment here. So adjustments that we have here is from the post RE, yeah? Post acquisition profit. So post acquisition profit, 15% the one that you dispose, time with 16,800 here is the RE brought forward. 16,800 here is RE brought forward. Okay, RE brought forward minus RE at acquisition. Okay, time with 15%, so you're going to have 810. So 810 compare with 1300, so you're going to have a positive movement in the equity of 490. Okay, this one is a cost method, and then the other one is a net method, so just focus on this one only. Cost method is simple as compared with this one. Okay, so now we're going to prepare the journal entry. So journal entry, you're going to debit investment in S. Okay, investment in S. Debit also investment income to record for the gain on the disposals, and credit the NCI. So NCI here, going to credit the NCI. Okay, because NCI bought that one, bought the investments here. So going to debit investments, okay, in S, okay, and then credit investment in debit also investment income and credit the NCI. Okay, and then shares of this one is to record for a positive movement. So positive movement here, that you're going to credit your RE and then debit the NCI for a positive movement. Okay, so that is what you have for the disposals. For disposal of that 15% or 20% from the interest. Okay, so the next one, we're going to eliminate the COI. So to eliminate the COI, at the beginning we still have 75%, so 70 times with 60. This is a RE at the acquisition, so times, and then the goodwill here is from a calculation previous. We have goodwill for parent here 16,450, and then credit the investment 70,000. Okay, and then we need to analyze the additional information. So additional information here, between S and P here, we only have one item here, item number 2. So item number 2 is an upstream sales. So you're going to debit sales for the current year and credit COGS, and then we're going to account for the URP here for the current year, debit COS, credit ending inventory. Okay, this one is for a previous year. Okay, for previous year, only account for the realizations of the URP. So debit the RE and then credit the COS. We don't need to account for the sales because it's already prepared. The journal entry is already prepared in the prior year. So we need to account only for the RE brought forward, to prepare a journal entry for the RE brought forward to show that the amount has been realized. Okay, so you're going to have here debit RE, credit COS. Okay, and then you have another income that you have here is related with a dividend. So another income that you have in as Berhad here is amount of dividends. Dividends of 4,200. So 4,200 here is from your movement in equity. The movement of RE, the movement of RE in the informations that you have here. So there is a dividend, proposed dividends of 4,200 here. So this one is a proposed dividend 4,200. So you're going to credit dividends, debit others income, and then credit non-controlling interest for the NCI here. So the portions here for the NCI here is 4.2 times with 40%. During this time the NCI has 40%. Okay, so and then credit others dividend, and then when you have a proposed dividend, you're going to prepare two journal entry, debit a proposed dividend, credit dividend receivables, and then credits others creditors. So the same thing with this one, transfer to this one. Okay, so and then we need to account for the NCI shares of profit. So NCI shares of profit here is 40% times with 533. So 533 here is profit for the year, and then minus 800 here is URP carry forward, and then plus 200 here is URP brought forward. Okay, so you have this one. You're going to have 1973,200. Okay, and then for the NCI here, shares capitals here, you're going to have 60 times 0.25. 0.25 here is at the beginning. When you eliminate here, eliminate at the beginning. Okay, so you're going to have 600 times 0.25, return profit 16,800 here, need to minus 200. 200 here is from here, the one that you realize here from the RE, debit RE, so you need to minus 200 here. So the profit for shares of profit for NCI here from the RE here is 4150. And then goodwill on consideration based on the calculation previously, and then credit the NCI. Okay, so this is what you have for P and S. Okay, the next one you have P and A. So P and A here we have indirect interest. So indirect interest here you need to find the value of the company. So the value of the company that you have here, so you start have the indirect interest in A when S acquired A on 1st of March. This one was happened on 1st of March 2020. So happened on 1st of March 2020. Means that before this, from July until February, is still as a associate. It start from 1st of March and then become indirect subsidiaries. Okay. July until February is still as an associate. So we need to find the value during until 1st of March 2020. Okay, so this is 25 whole by S. This is previous held equity investment. This is through P, and then this is the value of the NCI. Okay, this one on 1st of March here. So 1st of March, the value of A here is 1 ringgit and 50. So 1 ringgit and 50. We need to find the company value. So the company value of A here is 1 ringgit and 50 times with the shares capitals in A. If you look at here, the shares capital in A here is 80. Shares capital in A here is 80. Okay, when you time this one together, you're going to have here is 120, isn't it? And total up here, 80 times with 1 ringgit and 50. Okay, 80 times with 1.5. So you're going to have here the value of the company here is equals to 120. So we need to start with the NCI. So the NCI have 45%. So we need to time with 0.45 here. So time with 0.45. So you're going to have 54 for NCI, 54 for the NCI. And then for the previously held 30% here is 36. Where to get this 36 here? 36 here the same thing, 120 times with 30%. Okay, so you're going to have 36 here. Okay, 36. Okay, and then for the S here is already given. So the S here acquired A at the price of 32. This is informations number 1. This one is already given. So you total up here. So the company implied value here will be 122. 122. Okay, the fair value of net identifiable asset, the shares capitals here is 80, and then plus with 11,200 here is RE brought forward, and then plus a profit 5.5 here. Profit after tax needs to time with 8/12. Why 8/12 here? Is from July until February. So we're going to have 8 months here. 8 months here. So the profit, the one we're going to increase the amount of your investment. So you're going to have here is 94.9. So 20% time with this figure. So you're going to have 23. 30% time with this 94. We're going to have 28. 45% time with 94. So you're going to have 42. So altogether the goodwill here will be 27.1. Okay, for S here the amount of goodwill will be 8275, and then for P here will be 7.53. Okay, 7.53, and then for NCI here will be 11,295. Okay, so this was and then for the NCI here, okay, this is the amount that we have here. Parents goodwill Okay, parents goodwill here. So starting from 1st of July 2019, parents only hold 60%. So parents hold 60% in S. So for the goodwills in A, okay, parents going to have 60% time with 8275, time with 8275. So this one is a shares of goodwill through S, shares of goodwill through S here. So you're going to have here is equals to, okay, so you're going to have here 60% time with 8275. So the amount of goodwills that we have here is equals to parent portions. For a parent's portions that we have here is equals to 4965 here. Okay, so you're going to have here is equals to 4965. Okay, 4965 plus parent portion here is a 7530. So you total up these two figures. So you're going to have here is 12495 here. So this is the total amount of goodwill for parents here. Okay, from this 8275, parent only entitled 60%, yeah? Because parent have a share in S of only 60%. Yeah? Okay, and then the remeasurement gain. So you need to remeasure this amount of investments that you have here is 36. So 36 based on the fair value. Compare with the carrying amount. So the carrying amount that we have here is 31. 31 is based on the investment that you acquired at the beginning. You acquired investment is at the price of 31. 31. When you acquired 30% on 1st of January 2018, acquired 30% of interest in A. Okay, acquired 30% interest in A at the price of 31. So you need to find the new carrying amount. So you have 31. 31 is your investment. Okay, plus change in your profit. So profit that you have here, okay, you hold 30% here, time with, this is your RE. So RE and then brought forward minus 8. Okay, RE brought forward minus 8. So 11.2 is RE brought forward minus 8. 8 here is the RE at acquisitions. Okay, acquisitions. Okay, minus 8 here, and then plus with the profits here. Okay, plus with the profit here 0.33. Okay, time with, this one is the portion of RE, and then this is another one is a portions of the portions of net income. Time with net income that we have in A here. So the amount of net income that we have in A here is 6550. Okay, 6550 here, we need to minus 1000 here. So 1000 here is the URP for the sales of land. URP that you have here is 1000. So the one that you have here is only 550. 550 time with 8 over 12. 8 over 12 here is for that 8 months. So you're going to find here the CA here will be 33070. So this one you need to time with 8 over 12 because this one is only for 8 months before it become indirect subsidiaries. Okay, so you're going to have a remeasure gain of 2930. So you're going to debit the investments of 5000, return profit 2070 from here. This is the portions of RE, 2070 portions of RE, and then the other ones you have gain on remeasurement from here. Gain on remeasurement, so total up the investment in A here will be 5 million. Okay, the difference here is 5 million. So where to get, actually where is this 5 million come from? The fair value here is 36. Compare with the carrying amount that you have here is 31. So the difference that you have here is 5 here. So from that 5 here, there is elements of RE and also elements of a remeasurement gain. Okay, so this is what you have here. Debit investment and then credit RE and also credit rate gain on remeasurements. Okay, so the next one you need to have a share. So since you are still associates, okay, so you need to have a portions of the profit, okay, until 8th month, until 8th month from July until February, you still have a portions for that profit. So you're going to debit sales. This one is to eliminate debit sales, others income. So in the amount of others income, if you look at here, the other income that we have in A here, the total amount of others incomes here is 2.5 million. 2.5. But from that 2.5 here, there is elements of the URP of land. So you're going to have 1,000 here. So the amount of others income here is only 1.5 times with 8/12, because you want to calculate from July until February. Okay. Cost of sales here 15. Other operating expense also 5,100. Tax expense. So the difference here will transfer to the returns earning. Okay, so the returns earning that you have here is 555 times with 8.5. So means that this is your profit. So profit is going to be transferred to returns earning. Okay, so that is what you have for the remeasure the previous investments. Okay, and then we prepare the journal entries here. Okay, so the journal entry for investments in Permai, here is the investment in Permai. So we're going to have here shares capitals, okay, 45%. Okay, this one is from the return profit, also 45% here. NCI here is 40%. So this is your indirect. Indirect shares, you have 45%. So 45% here is time with 80. Return profit 45% time with RE. RE here is the RE brought forward plus the RE after the acquisition from July, and after the this one is RE brought forward, this is RE before they become the indirect. So you're going to have this one, so 6705. and the NCI here is 40%. 40% in, remember that in S, okay, in S parent has 60%, NCI have 40%. So 40% time with the investment in, okay, this one need to time with investment by S in A. So you have here is 32. So 11,800 goodwill here is already calculated, and then credit investment in Permai. So is it Permai the words that you use here? P and A. I mean there is a investment in A supposed to be. Okay, it's not Permai. Okay, so Permai, so investment in A supposed to be Permai, supposed to be A. So A that you have here is 32, here is by S, and then 36 here is by P. Okay, so we're going to have here 68. Okay, others income here, we have other income here is to record for the URP for land. So there be others income, credit land. And then for the shares of the profit, shares of profit here, NCI have 55%. So 55% time with 5550 is a current year profit, time with 4/12. 4/12 here is a profit from March until June. So March until June. So you have here 550 time with 4/12. This one is from March until June. So for the NCI here 10,17,500. Okay, and then for the NCI, to establish the NCI, shares capital 55% time with 80. Return profit here is 8195. To get the 8195 here, this is RE brought forward. Okay, and then plus the RE or from the profit here up to 8 months, from July until February. So you're going to have here 8195. Goodwill here, the total amount of goodwill here is 27. This is a goodwill in A. This one is a goodwill to parent minus goodwill to parents here. So you have 14605, and then credit NCI here is 66,800. So that one is to establish the NCI here. Okay, and then this is the statements. So the statements that we have here, you need to plus or minus the items that we have here. Yeah? You need to check this one. Okay. So the items here is come from the journal entry previously. Yeah. So this one is related with the sales. This one is related with minus 18 here. 18 here is related with item 12. Item 12 here is related with the eliminations here, okay, of sales here. Okay, 18 here is also from eliminations of sales here. Elimination related with the sales here. Okay, cost of sales, this one is from sales. 800 is the URP. Okay, and then this is URP brought forward. 104 here is come from the recognizations of the RE for the NCI. Yeah, so this one is also from sales that you have here, eliminations here. Okay, so you have here others income here minus 1000, add together the others income, and then minus 1000 here is for the URP. Yeah, okay, URP, and then 1000 here, and then 1300. Where these figures come from? 1000 here is from item number 14. 1000 here is related with the URP here, URP for land, URP for land, and then another 1000 here is item number 12. This is from others income. Okay, others income, and then 1300 here. 1300 here is from, let's check this one. 1300 here is from item number, the first one. Okay, the first one here you have the gain on the first item. Let me check for that one. Okay, 1300, 2520, and then 1300. This one is related with others income. Yeah, others income 1000 there, and then you have another one 2250. Okay, 2250. You need to check this one. 1000, another 1000, and then 2250 here is related with the dividends here. Dividend 1300. 1300, the one is come from, where is that 1300 here? Others income, investment gain, from the investment gain. First item, first journal entries. Okay, and then operating expense, so you need to find, this one is from your journal entries. Okay, just want to show about this one. The RE, how to derive to your RE is all this one is from your journal entry. Okay, so you need to prepare for the journal entry, and then the items in the comprehensive income and the segments of financial position, you just add plus from the journal entries. Okay, this is how to calculate the RE brought forwards. Okay, the RE, the ending balance of the RE. So you have RE for that three company, add together, and then this one is from journal entry, and then minus the dividend paid. Then you have an RE, ending RE. Okay, so this is for questions 2. A little bit complicated for questions 2. Just have a look on this one. If you have any questions, so we're going, please ask. Okay, make sure that you get this, watch this recorded class, and then ask the questions during this coming Monday class. Okay, so we are done with questions 2. Okay, so now we move to questions 3. So questions 3, I just want to show you the journal entries only, and then for the statements, you just prepare that one. Okay, for questions 3 here, there is something. Okay, questions 3, the one that in red colors here is the one that you're supposed to have. Suppose that we make an amendment to this one, because if you refer to your previous questions that we have here, this is based on your previous questions. If you look at here, the dividend income here is before profit after tax. Okay, sorry, it was put under before profit before tax. It means that this amount is already gross. Suppose that for the dividend treatments here, we need to put it under net amount. So it's supposed to be net amount for a dividend, supposed to be like this one. But since I haven't make a corrections, I really realized this one there is a dividends put it here with the which is not after tax. So we just are going to give you the answer based on what you have from the questions. We're going to base on this information. Okay, this one is the red in colors here is when the dividend is using the net methods. At the end, your income statement will be the same. Either you are using the net method or the gross methods here. The gross amount of the dividends here, you're going to have the same amount of net income. So we're going to discuss based on this one, based on what you have in your questions, information that you have in your questions. Okay, so on 16th of October 2018, P acquired 80% interest in A. So P acquired A 80%, 80%. Okay, with the cash considerations of 20 million and 60% interest in C. So in C, he says a 60%. Okay, for cash considerations, 30 million. On the date, the market price of A here is RM1.25, and then on C here is RM1.40. Prior to that, on 28th of May 2017, C acquired interest in B. So C is already have a shares in B, already have shares in B, 80%. Okay, 80%. Okay, when the return profit was 4 million, and then the consideration paid by C to acquire B here is based on proportionate shares of the fair value of the company as a whole. Okay, so C acquired 20%. So when C acquired 30%, means that the NCI here is 20%. But look at the next one. On January 2020, B, after that, P acquired B, another 10%. So now the NCI here is only 10%, because P have 10%, C has 80%. So NCI in B here is only 10%. So NCI in C here is 40%, and then NCI in A here also 20. This one is 20%. Okay, and then it said that later that year, on 30th of September 2020, P sold 10 million shares in A. So P sold 10 million shares in A. So we look at here, A. So P sold 10 million. 10 million divided by number of shares that we have in A here is 20 million. So means that P sold 50%. So when P sold 50% in A, okay, before this P have 80% in A, 80%, and then after that it disposed in A. In A, P has 80%. After that it's disposed 50%. So means that now you only have 30%. So 30% here is considered as an associate. So means that A is no longer a subsidiary, is only an associate. Okay. So the market price for this share at those date was RM1.29 and RM1.55. RM1.29 is for the when P acquired B, and then RM1.55 here is when P disposed A. Okay. So the one that red in colors here is mentions about the methods and net methods and the cross method. So the things that I'm going to discuss is based on the questions that you have, okay, information that you have in the question. Suppose that it will going to be the red in color is the correct one, because the dividend should be net after tax. Okay, so this is what you have, and then we're going to have RE brought forwards and also the return profit. So we proceed now. Okay, so investments altogether you have 45, 30. Okay, this one is 40. This one 40. ABC. Okay, A sold merchandise to P. Okay, A sold merchandise to P here at the gross profit margin of 20% in the year 2020. So now P only have 30% in A. Okay, so P only have 30% is considered as an associate. So A source here, A to P here is a upstream. Okay, so sales here is 4.5 million, and then at the year end, and 1.6 million is remain as a inventory. So you still have 1.6 million. So 1.6 million here you need to time with 25% here. Time with 25% here. So you're going to have the URP here. The URP amount here is for hundreds. Okay, and then P sold piece of land to B. P to B. P to B here is a downstream. Downstream. Okay, on 31st March of 4 million for 5 million. The land was only bought by A on 31st August 2015. So the land that is sold here, if you look at here, if you want to know how much the sales of gains here, the gain for this one is 2560. It's already have here in your income statement. So there is a gains there. Gain of 2560. Assume that the company tax rate 25%, but you need to ignore the unrealized profit. Tax effect on the unrealized profit, that means that there is no tax, and then there is no changes in the shares capital for all of the company in the groups. All dividend were paid during the current year. Revenue was accrued eventually. Group policy is to measure NCI at fair value. So the things that you need to do here is to prepare the consolidated journal entries. Okay, proceed with the answer for questions 3. Okay, so now we're going to look at the movement in the equity. So movement in the equity here, at the beginning you start with 80%. After that you dispose 50%. Now it become only 30%. So when you dispose here, there is no longer become your subsidiary. You only have an associate here, but we need to look at the value at the acquisition date. So 80% means that NCI have another 20%. Okay, in C, P has a direct of 60%. Okay, and that means that NCI have another 40%. So in B, indirect, we have a 10%, which is acquired on 1st of January 2020. Indirectly through C, this one is through C. So P has another 48%. So 48% here is 80% times with 60%. So 60% times with 80%. So because C have 80% in B, so indirectly, so 60% here in investment in C, and then 80% here is C in B. Okay, that is what you have. Okay, so 48% indirect. Okay, so for NCI direct here only has 10%. 10% here is because parent have 10% plus C has 80%. So 10% direct. Indirectly through C. Okay, through C, the investment in C that you have here, NCI have 40. So 40 times with 80%. So you have another 32. So altogether you have 32. Then you're going to have hundreds here. So indirectly parents have 48%. Okay, so now we're going to look at the from P to A. So P to A here, instead of A become a subsidiary. Now it's changed from subsidiary become an associate because it's disposed 50% of shares. Okay, so for 50% of shares here, we need to calculate if there is any gain on disposals. Okay, at the disposal, the first thing that you need to do here, you need to remeasure gain on the remaining state. So remaining state, at the beginning you have 80, you dispose 50. Okay, 50 dispose, and that means that remaining you have another 30%. So remaining that we have here is 30%. 30% here, you need to find the cost of investments. Okay, the cost of investment, if you look at here, okay, if you look at here, the cost of your investments here at the date, at the date when you dispose here, the market price of the shares here is RM1.25, RM1.25, 125. Okay, so you're going to have here is a COI here based on the value at the acquisition date here is RM1. So the value of the company here is RM1.25. Okay, time with the value the shares capital here is 20. So you're going to have here is 25. So 25 time with 30%. So 30% you're going to have 7.5. 7.5 here is the COI plus the RE brought forward. So RE brought forward 3.5 minus RE at the acquisition, and then time with 30%, so you're going to have 450. So this 450 here is the increase in the RE. Okay, and then the other ones, you also have a shares in increase of the profit. Increase of the profit. Profit here is 2 million time with 9/12. Time 9/12 here is because you dispose your P. Okay, on later on 30 of September, P sold 10 million. So dispose on 30 of September. So you entitled profit for 9 months. So this is shares from a current year profit. So the total COI here will be 8.4, and then the fair value of the remaining state, at 30 of September. So the value here is RM1.50. This one is the value at 30 of September is 155. So time with 20 here. So you're going to have here 1.55 time with 20. So you're going to have 31. Okay, 31 here, 31 time with 30%, so you're going to have 9.3. So that is a fair value. So the difference that you have here is again on remeasurements here is 900. So remeasurements here is for that remaining stake of the 30%. Okay, so the next one we need to calculate gain on the disposal. So when you dispose here, so cash consideration that we receive when you dispose here is 14.2 minus cost of investment. Cost investments that you have 40% time with 25. 40% time with 25. So 25 is the value of the company. So 50 time with 25% is 25 million from here. So you're going to have 12.5 here. So the amount that you have again for parents here is 1.7. So from the gains of parents, you need to find gain for the group. You need to minus the post-acquisitions reserve here. So post-acquisition reserve come from your RE minus RE at the acquisition time with the disposal here is 50%. The same thing for the profit here. Now we need to time with 15%. 9/12 time with 50%. So 750 is 1.5 here. So the difference that you have here is 1.7 minus 1.5. So you're going to have 200. So 200 here. Gain to the groups that you have here. Okay, total up with the remeasurements gain plus with this amount. So you're going to have 200 plus 900 here. So you're going to have 100. This is a total gain. So this 200 here is gain from disposal. 900 is gain from the remeasurements. So you're going to have altogether 1.1. Okay. Now prepare the journal entry. The first one, you need to debit gain on disposal of shares. This one is for the RE, credit RE here. So the RE that you have here is 1.2. It's come from gain on the disposal, so it's from here. Okay, the other one is gain from the remaining profit, remaining investments. So you're going to have investment in associate. Okay, debit investment in associate, because that one is the increase in the value of your investment due to the shares in the RE. So you're going to have 450. So this one is for the disposal, and then this one is for the remaining, and then credit your return profit. Okay, and then the next one is to record for the gains of the fair value of the investment. So investment in associates 900 here, so 900 you have here, and then credit gain on disposal. So 900 is from the previous calculations here, from the gain on the remeasurements. To account for the fair value here is a remeasurement scheme. Okay, debit 900, debit investment, and then credit gain on disposals. Okay, and then the next one, you need to account for or recognize the amount of the income and from that 9 months. So debit for 9 months before the disposals here, 9 over time with 7, and then you have operating expense, also need to time with 9 months here. Okay, NCR here, gain on disposal of shares here is 750 from the disposal. Investment in associate, this one is from disposal. Investment in associate here is for the remaining. Okay, for the remaining. Okay, and then you have taxations times 9 over 12. NCI here, NCI 300 here is 2000, time with 9 over 12, and then time with 20%. NCI portions here is 20%, and then credit revenue 8175. All this the item you need to time with 9 over 12 here. Okay, and then you have here to equity shares of profit. Shares of profit here for the next 3 months. Remaining 3 months here, you have total profit is 2000, time with 3 over 12, time with 30%. This one will increase your investment. You're going to account for shares of profit 150. Okay, and then this one is to eliminate for the URP. So URP that we already calculate here is 400, but from that 400, okay, since P only have 30%, so you need to time with 30%. So you're going to have 1200. This one is record for the URP, partially or URP. Okay, that one is between P and A. Okay, the next one is P to C. Okay, for P to C here, P has 60% in C, 60% here. Okay, only have 60% in C. Okay, 60%. Okay, shares capital 30 times 60, return profit brought forward here is 6 million times with 60, and then the goodwill on considerations here. So the goodwill on considerations here, you have 30 from share. This is your net identifiable assets. Net identifiable asset 30 from shares capital and 6 from the RE. So altogether you have 36. Okay, 36 here. Okay, 36, and then time with 60%. Time with 60%. So you're going to have here 21.6. This is equal to 21.6. Okay, 21.6, and then minus your investments here is 30 million. So you're going to have here 8.4. Okay, 8.4. The goodwill on the goodwill amount 8.4 for parents, and then credit investments. Okay, for NCI here is to record NCI for the current year. So NCI for the current year, the one that you have here is 1.4. So 1.4, what is this 1.4 here? Is a profit. Profit in C. Okay, profit in C here is 1.4. So 1.4 times with 40%. NCI has 40% in C, so we're going to time with 40%. So this is shares of profit. And then for shares of capitals, to establish the NCI here, shares capitals here 40%. RE here is RE brought forward, time with 40%, 8.4. And then goodwill on consolidations here. So the goodwill on consolidations here, going to have here the fair value here is 30, time with 40%, so shares capital, and then time with 1 ringgit and 40. So this 1 ringgit and 40 is value for the company as a whole. 30 time with 1 ringgit and 40. Now to get that 1 ringgit 40 is at the date when you acquired C. So the fair value here is 1 ringgit and 40. Yeah? So you're going to have here 30 times with 1 ringgit and 40. So you're going to have here is equals to 42. So from that 42 times with 40%. Okay, you're going to have 16.8. 16.8, and then compare with the net identifiable assets here. So you're going to have 36 times with 40%, so 14,400. So portion for the goodwill for the NCI here will be 2.4. Okay. Okay, so this is what we have shown since there is no transaction between P and C. Okay, the next one you have P and B. P and C here is a direct, so you have a direct of 60%. Okay, P to B is indirect. So P to B indirect, we have about 42%. Yeah. Okay, so now we're going to look at here P to B. Okay, P to B NCI has a 20% at the beginning. At the beginning before parents bought another 10%. Yeah. Okay, parent price here is 80%. This one is through C. Yeah. Okay, so the company value, implied fair value here is 40,000. So value of shares time with 20 divided by 80. Yeah. So to find the value of the company, so the value of the company here is 40 divided by 0.2. So you're going to have here 0.2 divided by 80. So, okay. So if you want to calculate this one, you can use this one, 40 divided by time with 20 divided by 0.8 to find the value as a whole. So the value as a whole here, you have 40 here, for the NCI is 10, so altogether you have 50 here. So you're going to have 50 here. Okay, that 50, and then for parent portion is 40, NCI is 10, the fair value of assets here is 40 plus 4, so 44, the goodwill here will be 6. We're going to have here 4 ringgit and 80. P acquired B indirectly. Okay, so you're going to have here for the parents here 4.8, and then for the NCI here is 1.2. We're going to parent portions of goodwill. So parent portion of goodwill here, total goodwill that you have here is 6. Okay, and then the parent portions here is only 2880. 6,000 times with 80%, since owned in B, time with 60% here is B owned in C. So you're going to have here is 4,800. Previously, based on the C goodwills here is equals to 4,800. So from that 4,800, parents has a portion of 60%. So 60% times with 4,800. So 60% times with 4,800. So you're going to have 2,880. So this is a portions for the goodwill for the parents. Okay, it's 2,880, and then total goodwill. Okay, total goodwill was 6. So 6 minus 2,880. So the remaining that we have here, which is equals to 3,120 is for NCI. Okay. So now prepare the journal entry. Okay, shares capitals here, so you are using indirect, so parents has indirect 48%. So 48% through C, through C, parent have in C, parent have 60%, P to C 60%, C to B, C to B. Okay, C to B we have another 80%. So indirectly parents have 48%. So shares capital 48% times 40, and then this one is 48 times 4. Okay, return profit, and then for the NCI here, NCI has 40%. NCI have 40% time with 40% here is the investment by C. Okay, investment by C. So C's have 40%, so we're going to have 16 here. Goodwill is from here, the one that you calculate here from here, and then credit investment at cost of 40,000. Okay, that is what you have. 40 million. Investment at cost here is 40 million. Okay, we look at this 40 million. This 40 million is come from investment by C. So this one is investment by C. 40 million here. Okay, now we're going to look at the movements in the equity. So the movement in equity here, once parent bought another 10%. Okay, when parent bought another 10%. Okay, so parent bought another 10% here. We need to find the value of the company. So the value of the company based on the NCI applied value here. So we're going to have 40 divided by 0.8. Okay, so you're going to have time with 20% for the NCI here. You're going to have 10 million. 10 million. Post acquisition reserve here 5.6 minus RE at the acquisition here is 4. So you're going to have time with 20% 320. So the carry amount is 10,320. From that 20%, NCI dispose 10%. So 10 divided by 20 time with the 10,320 from here. Okay, so you're going to have here is the transfer here is 5160. Compare with the COI here is 8,000. So this is the amount of the CA carrying amount. So the investment that you need to pay here is 8 million. P need to pay 8 million to acquire B. That for that 10% here. Okay, 10% they pay 8 million, so it paid more, so you're going to have a negative movement in equity to 840. Okay, so now we're going to prepare a journal entry. We're going to credit investment in B at cost. Okay, this one is to eliminate the investment, so credit the investment at cost 8 million. Okay, you need to pay to the NCI 5160, and then the other 2840 here is a negative movement. So negative movements that you need means that you need to debit the RE. Okay, then you're going to look at for the NCI. So NCI, since parents have 48%, so NCI have another 52% here. So 52% here time this one is at the beginning here. So you're going to have shares capital times 52 times with 40. RE here is RE brought forward 5600. So 5600 time with 52%. And then goodwill here is from here. Portions of goodwill here is 6,000 minus 288, which is a goodwill to parents here. So you're going to have 3120, and then credit go NCI at the segments of financial positions to 6832. Okay, and then this one is a shares of profit. So shares of profit to record NCI for a current year. So record for the NCI current. If you look at here at the beginning, NCI has 52%. Now NCI dispose 10% because it sold it to parents here. So now the NCI value here is only 42%. So 42% time with a current year profit which is 2 400s, in B, 2 400, so you're going to have 1008. Okay, and then the transactions between P and B here is only item number 2. So item number 2 sold a piece of land. So piece of land at a price of 5 million, and then the amount of gain here is from the income statement. So debit gain on sales, and then credit land or others asset. Okay, and then the next one, you have a dividends in B. Okay, B also paid dividends of 1,800. So paid a dividends of 1,800, 1.8 million. So from that 1.8 million, going to pay to P here is a 0.9. 0.9 here is 80% through C, and then 10% through P. 20% through P. So the NCI are going to receive 180. Okay, if you refer back to this one, either you are using the net method or the gross method, at the end the amount of profit is the same. The amount of profit will be the same, but the method it's supposed to use here is based on the net method. We should use this method because the dividend should be net after tax, since there is no changes in the question previously. So I provide you with two sets of answer. If you are using the gross dividends, or you are using the net dividends, the gross methods or the net method, at the end you're going to have the same amount for the profit. Okay, 5150. Okay, the same thing. Okay, and then this is what you have for the statements of the financial positions. Okay, so this is A become an associate. Okay, so this is what you have, the answer for tutorial 1, and also tutorial 4, the cash flow, and also for the tutorial 3, changes on group structures. So please, for the next class, please study on this. Make sure that you watch for this recorded PowerPoint. Study on this one. If you have any questions relate with your tutorial 4 and tutorial 3, I'm going to allocate maybe half an hour before we continue with your full rate operation this Monday class. So I'm going to answer any of question from your tutorial 4 and tutorial 3. Okay, so going to stop this one. So we're going to discuss again if you have any questions regarding tutorial 4 and tutorial 3. Okay, hopefully that you get something from this tutorial. Make sure that you try to redo this one, check your answers and try redo and understand what your mistakes there. Make sure that you prepare for the exam on this coming Tuesday. Your exam will be on Tuesday. Okay.